learn how to maintain the appropriate risk reward structures. One of the problems, one of the things you're trading for probability is profitability and also risk reward structure.
Before we get rolling here, just a reminder to please like and share our videos. Your support helps us to continue to bring you the wonderful content that we share with you each and every week.
So trading is this combination of risk reward and probability. And one of the challenges that we can have with the more market neutral structure is the structural risk is huge compared to your average reward. So in a lot of these trades. So in other words, I might have a risk of $50,000 in a position, say. So I might have a structural risk of $50,000. I might have a potential reward of $5,000. What's that? That's 10, that's 100 to 1, right? I have 100 risk for one reward. Now we try to contain the risk through stop losses, but we also have this overnight risk issue where we can get these huge move overnight, meaning we might exceed that. So our realistic risk is like higher than our stop loss. It's maybe 2 to 3 times our stop loss. So now I have a reward of $5,000. I have a theoretical, like if I can get out at a normal stop loss thing of up to 3 times that. So I have a 15,000 risk per se for like a $5,000 reward, and those dynamics will play out, probably not quite that bad. But that my point being, that's not a good risk reward structure. I can come in to do verticals and be directional, and I can have a one-to-one risk reward structure usually fairly easily or something close to that. And then I can do long options, and I can have a risk reward structure of maybe 100 reward to 1 risk, right? So that's like a really important dynamic. Like I said, a lot of people in the market neutral world tend to focus on probability. You can have a 95% probability trade and blow up easily. We've seen this happen in many hedge funds coming along where they win more than 90% of the time. Or of course you have the fake ones that say they win 95, 100% of the time, like Karen, the super trader, who eventually blew up and got exposed for the way that they were doing the accounting, which was very, very deceptional. But they're like preying on people who are going for probability. I just want to win all the time. I don't want to experience any losses. I can't have a drawdown. That's the biggest way, or one of the easiest ways to blow up. So we want to be very, very aware of that and make sure that that isn't our only focus, that we're also dealing with risk reward. Like I said, we can do fine doing the market neutral stuff, and I think that that's a good skill to have, and I think that positional analysis and so forth is a really good skill to have. And you can pull on that when you're trading other ways, but we can get much, much better risk reward in our more directional structures. And I will say that if you're being non-contextual with the market movement or price action, the probability probably isn't like really super, but during my learning journey, like I had a lot of different mentors, and I realize now that I'm like more advanced in understanding of things, that some of them were really bad mentors and some of them were really good mentors. So one of the things that we would used to say is like, you don't want to buy an option like when we're doing directional options trading. So like one of the things that was told to me is you don't want to buy an option that's less than 80 delta, because if you get much poor past 80 delta, then the option's really not any good. It doesn't have any intrinsic value. And you're not going to win that way, right? Because if you get the price move, then or you're not going to get a price move that big to offset the lower win rate if you go further out of the money, right? So an 80%, theoretically an 80% 80 delta option is 80% chance of expiring in the money, right? So, and it's like a 20%, like a 20 delta option has like a 20% chance of expiring the money. That's the theoretical thing they tell you, which is a bunch of crap actually, because those probabilities completely depend on what price movement is likely to do, right? And if you understand price movement, you might understand when a 20 delta option is very appropriate, and when an 80 delta isn't. But anyway, that's what he told me. He goes, anything like that is crap. You don't want to trade that way. And then from the very same company, I had another mentor who told me that, look, you want to buy these little crappy options that are like 50 cents. He said, a lot of them don't work out, but when you win, it's huge, right? So this other guy, and this was before 2008, which was the financial crisis time. Well, the guy that was doing the 80 delta options, later found out, I don't know if you guys know this, but I actually worked for Invest Tools for a while. They saw the results that I was doing and they wanted me to come in and help teach their students, right, how to do this. And I would go to seminars and so forth and help teach there. But I would talk to the other instructors, and the other instructors basically were not making any money, which is one of the reasons they wanted me there. And how do I know this? Is because the way they're acting. They're asking me what I'm doing. They're like way too interested in how I'm making money. Like if someone comes up to me and tells me, hey, I got this wonderful trade and I've been making all this money for the last year. I'm like, okay, and I might have a casual interest in what they're doing just to see what they're doing, and mainly for the purpose of like just seeing what they're doing, see if it looks like it's viable and stuff like that, right? But it's more like a casual interest. These guys were like, oh my goodness, you're actually making money, and how do you do that? Like they're like way too interested in what I was doing. And that basically tells you that these people aren't really making anything, right? Because if you're doing like really well on your own, you're not really that concerned if someone's doing a little better than you. It's probably temporary if you understand what you're doing, right? Who knows, right? We have temporary bouts of success and everything. So these guys were like way too interested. So I realized like they're like not really making any money. Anyway, this other, it's some of them were, but a lot of them weren't. But this other guy who was doing these way out of the money things, he only won like 10% of the time, right? In other words, he'd lose like 90% of his trades. But when he won so much money, it would like obliterate any loss that he accumulated. So, he'd like lose, I lose $50, I lose $100, I lose $500, I lose 1,000 here, and then next thing he knows, I made $80,000. It was like holy Batman, right? Whatever. It was, the guy was like much more profitable than this other guy telling me this other thing, and he was doing the crap options that nobody wants. And I'm not saying to trade that way. I'm just saying you can make money a whole bunch of different ways, but it's not about how often you win. You can make a ton of money winning only 10% of the time, and you can lose money winning 95% of the time. So don't be like overly focused on probabilities. Understand your risk reward structure. And that in conjunction with probability is also important. But your probability is going to be like the hardest to estimate. Your risk reward structure is really easy to, like, what your risk reward structure is. Because say any idiot, I don't like to use that word, but basically anybody can calculate a risk reward structure. It's not very hard, right? And you want to understand what that risk reward structure is, and you can do it relatively quickly. Probability is harder to really estimate in the real world. It's easy to estimate when you look at like a options Greek, but the reality is if you look at a Super Bowl and you use the common method for calculating profitability based on delta, the Super Bowl would only win like 40% of the time, but that trade wins like 90% of the time. So that in itself doesn't really mean anything. probability is a little harder to calculate, and it's more of an estimate, where risk reward structure can be very specific and it's fairly easy to calculate. It's a little bit harder if you're using a stop loss, because then you have to figure what might happen if problems happen. But structural risk reward is really easy to figure out. But you want to learn how to maintain and apply appropriate risk reward structures, and that is in regard to probability. If you're doing good structural risk reward structures, you don't really have a black swan worry at all, like if you're doing appropriately sized. Whereas if you're doing like very high risk reward structures from a structural standpoint, then you have black swan concerns, because now you probably have a lot of your money into the thing, and you're not making a lot on that money, so that becomes problematic.